Welcome to our mid-month update, and there is a stink in the air. Stink in the charts, the overall markets, earnings projections, European markets. But there's still a lot to talk about. So stay tuned and let's get started. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click Show More for additional information and links from today's video. Also, if you find this video of value and are looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. Let's get to the big charts. So, we have a new tool that will hopefully help us better demonstrate some of the charts that we talk about. First up, we've been looking at this chart all year, and we've been stuck in this box pretty much. We had our breakout, came back down, another breakout last week, failed by coming back in, and you can see that right there. What else do I see in this chart right now? I think a couple things. First off, down here is your volatility index. We're at a 20 right now. We look at 17 to 25. If we're in that range, it's still a risk-off range, obviously above as well. So the other thing I look for is right here. That's your 200-day moving average. Now, if you can look back at the beginning of the year, we tested it a couple times, but really continue to close above it, where now we've had several days below the 200-day moving average. And from a technical standpoint, that is not a good thing. So next up, when we take a look at another chart over here, I will look at, let's see if we can go here. All right, we'll go right here to another daily chart, and let's take a peek here and see if there's anything different. First off, up top, relative strength. Still can't really get above 50, so we're not seeing a lot of strength there. At the bottom, when I take a look, momentum. Yeah, it was turning up, but it's still below zero. So that tells us there's not a lot of good momentum in the market right now. What else? The big one, right here. Here's your 50-day moving average. Let's say right now that's your trend, and here's your 200-day moving average. Well, right there, that cross, that would be considered a death cross. Not a good thing. So right now, short-term signals continue to be negative, and we will go over it a little bit what they all mean as far as our portfolio construction. So let's move on to our weekly view, okay? When we take a look at our weekly view, what are we looking at here? I think the big thing is, there's your trend line from 15 and 16, and clearly we are still below it. So that's one of those reasons we've also have been negative right now. Momentum on a weekly midterm chart continues to point down. Not good at all. So again, when you look at this chart, it's pretty evident that we are still below that trend line. Okay, so one more view at the weekly charts here. So this is from your 09 bottom, okay? Obviously, you can see the trend line, and here's the thing, right? We are sitting right on it today. So that's a bit of a concern right now as well. If we break through, we're talking about breaking through a trend line from the crash, which is not good from a technical standpoint. So right now, when you look at our overall midterm signals, we are still negative on our midterm signals. Okay, so let's take a look at our monthly view and what exactly do we see here right now. So a couple things, I pointed this out before. That's called negative divergence. Why? Because we hit all-time highs, yet relative strength got weaker. Now, the big thing I'm seeing this week, look at that, crossover. MACD momentum crossover in a monthly chart. Not good at all. That being said, we don't confirm that until the end of the month. So we might come up, but you can see we've tested the trend line and does not look good at all. So if we continue here, and I want to show one other view because I found it to be really interesting. Okay, this is a new chart that I created this week. All right, so we're going to go back here to 1995. And what you see is your 12-month moving average. That's your red line here, okay? You can kind of see it right there. If you're above it, that's good. If you're below it, that's bad, okay? Pretty simple. Now we go back to the last crash. All of these are QE, right? QE, Operation Twist. Remember that one? We had one more here, but then up top we have QT, quantitative tightening. Talk about that more in a second. And you can see, to me, it's not surprising that we're going down. So looking at it, and then the other thing is right there. We went over the line there on a 12-month moving average. So another concern. That being said, our long-term signal is still positive at this point. So let's move on to the Nasdaq. The Nasdaq, what are we seeing here? Obviously very similar to the S&P look, but what else stands out? Well, I think a couple things, obviously. Let's start at the top here. Relative strength has been really weak, okay? Same goes down the bottom. Look at momentum. When you look at momentum down here, still below, way below zero with momentum, and we're looking to almost have another crossover, so it does not look good. And Nasdaq has gotten hammered with the fangs really falling apart. So what else do we see here on this chart? Well, hopefully you're watching and paying a look. Look at that. We are real close to that death cross. So I looked at Nasdaq, lots of weakness. Another big company this morning really got hit after earnings last night. They all have. So this is definitely a concerning chart. Big tech has driven this market, and if we go down here, it's definitely going to affect the overall markets. Now let's talk about the overall strength of the market. Been showing this one for a while. Okay, when you see this, new highs minus new lows. Okay, so this area here, that's pretty crazy, huh? That area right there is new highs minus new lows. Let me go a little bit slower. And then you see, very strong. And at the same time, the S&P hit all-time highs. And then over here, we were hitting all-time highs. And yet, strength on new highs minus new lows continued to go lower. So not really a good-looking chart. And then obviously, look at over here. We're back down in that negative territories. Okay, next up, those companies above or below your 50-day moving average. So the average price over 50 days. So this would be more of a short-term indicator because it's only 50 days. Above 60% is bullish. Below 40% is bearish. And here we are, right? I mean, we're at 36% as of the other day. Back up to 43 today. So we'll see what happens. Here on the Nasdaq, we're at 42. So just barely holding on after long periods in that area. So if we go down to here, okay, we take a look, and then here's our mid cap and small caps, okay, and same thing, pretty weak. It was 30% yesterday. Today, we're at 37%, so still in that bearish territory, and then same for the small and mids, okay? So short term, still weakness. You want to see that push up above 60 in order for us to feel better about what's happening with the overall market. Now, a better indicator for me is going to be our 200-day. So let's take a look at our 200-day. Keeps doing that, not sure why, but it is a new toy. Okay, so same concept here, but 200 days, a longer period of time with that average price. So this shows you the long-term averages here, right? Same thing, above 60 bullish, below 40 is bearish. So today we're at 46 as of today. Little bit bump up. Same with The Nasdaq, not 36, we're actually at 46 today, so seeing a little bit of strength, okay? And then if you look at mids and smalls, same thing. Still below 40, still below 40, so the broad market still fairly weak at this point. Let's talk about global synchronization or not synchronization. Here's the German DAX. What do we see here? A lot of things. There's your all-time high back in the beginning of the year, like the U.S. markets. But then that's your death cross. Not a good thing. Up top here, relative strength. Weak. Have not been able to really sustain anything. Continue to see a series of lower highs and below zero on momentum. So none of those are good at all. And remember, last year, Germany really carried the European area. So from there, if we take a quick look at the rest of the area, so we're looking here at the EFA, okay? You can call it the EFA or the MSCI index. And same thing, right? When I take a look over here, we're going to see obviously your death cross, which happened in July, a little bit after Germany, continue to go, tried to come back up, and then a series of lower highs. And same thing with momentum. So really, global synchronization is not happening at all. I know that Draghi, I don't know where he's been, came out this week and said, yeah, we're kind of a little bit slow right now. Seems to be missing the mark just a little bit. So next up, we'll look at China. Okay, obviously China being the second largest in the world. And what do we see here? Well, a couple things. Continue to see deterioration. There's your death cross way back in April, before the trade talks, by the way. And again, lower highs, lower highs, lower highs. Ugly, ugly. China as a whole continues to really struggle right now. So now we take a look at emerging markets, and this is known as the BRICS. Brazil, Russia, India, China. Obviously a very similar view here. Number one, there's your death cross. They've been in a downtrend for quite some time. So you've got international area, emerging markets, all in a bear market right now, none of which bodes well for the overall markets. And eventually, it's going to catch up to us, which is what we're seeing right now. So from there, let's now talk about tweets of the week. Let's go to tweets of the week and what caught my eye. David Rosenberg, good follow. Here's what he has to say. Word to the wise. We have endured two 10% corrections here in the same year. Haven't really seen that very often. In fact, the last couple times we saw it, 73, 74, 87, hello, 2000, 2001, 2002, you catching my drift here? 2008. So very interesting. Need to continue to watch that. Next, we have Lisa, and I don't want to hurt her name, but Lisa A, we'll call her. Another great follow. Big U.S. companies spent more money on buying back shares than they did on capital expenditures in the first half of 2008. That's not a good thing. One of the reasons why we saw our markets go higher. Next up, let's talk about what keeps me up at night. Well, here's an article from John Maudlin, great economist. The biggest economic threat in 2008 is quantitative tightening. Now, he showed that on the charts, okay? And again, going back and showing this long-term view doesn't look that bad, because what we're doing is we're slowly selling off and letting some of these purchases mature. But starting in October, continuing in November, they're letting go 50 billion a month, up from 10. Take a closer look, a little more dramatic. I will tell you this has a direct impact on the markets right now. Why? Liquidity. That's what it's all about. So next one is the debt, the overall debt. Again, we don't talk about this on big TV, I've got the website here, debtclock.org. Not pretty. That thing is spinning. 21 trillion, almost going to 22 trillion in debt. It's a bad situation. Here's a chart that shows by president how much they have added. At some point, this has to be addressed, and believe me, that keeps me up at night. Next up, let's talk about bonds. First, overall, when you look at the bond market, it's interesting. We have seen a little button hook down there. That has bode well for us in the markets. Obviously, the volatility in the equity markets are going to help the bond market. The other big thing is your 10s minus 2s, right? This is your 10-year treasury, okay? Your 10-year minus your 2-year, and we're down to 0.26. As a reminder, when we invert, go below 0, that is a clear indication, a leading indicator into a recession, so that's why we continue to watch and show this. The other thing, if you have not seen, I did a video on bonds and what to do about bonds, since they really have been somewhat anemic this year overall. Wrapping things up, fear and greed coming in at a strong 9, up from 7 2 weeks ago. Obviously, a lot of fear in this market right now. You can click below to find out how they come up with these calculations. Reminding you our signals are negative, negative, short and midterm, positive long term, definitely in a risk-off fashion right now. Take care. Thanks so much for watching. Michael Loftus for Wealth and Wisdom TV.